Advanced Financial Modeling, Topic 9, Forecasting Financial Statements, Free Cash Flows, and Stock Valuation. References you can find in the Benninga textbook, Chapters 2, 4, 5, and 6 from the 4th edition. Learning objective number 1, we're going to forecast financial statements. So why forecast financial statements? When I talk about financial statements, we're talking about the balance sheet and income statement. So why would I need to forecast these financial statements? Well, forecasting the financial statements is an integral part of the strategic planning process to ensure a corporation meets its revenue, profit, and earnings per share targets, invest in CapEx and working capital, for example, inventory, are consistent with revenue and profit targets, secures debt or equity financing for CapEx or working capital, determines the optimal capital structure, in other words, the mix of debt and equity financing needed to make those capital expenditures, and cash flow distributions to shareholders are consistent with investment needs, optimal capital structure, and shareholder preferences. So making sure you're generating enough cash to do the things you need to do. Also, when we talk about forecasted financial statements, sometimes we just use the term pro forma, kind of a matter of form. So when you hear pro forma financial statements, they're just forecasted financial statements. So what are the ingredients to forecast income statement and balance sheet? The number one, you want to start with sales growth. How much more are we going to sell this year versus last year? I'd say you'd first start with inflation. If general inflation is 3 or 4%, and you would assume you would grow by 3 or 4%. Then you'd consider market growth. Well, what if your market's growing at 5 or 6%? Maybe that's a starting point. Then you look at market share. If you're increasing or decreasing market share, your growth will be greater than your market or industry growth. And then the last one is production capacity. If you can't produce more goods because you don't have a large enough production facility, then that's going to impact your sales growth. So that's going to be the number one forecasted item is sales growth. Next, you're going to look at your operating cost. Are your COGS, which are cost of goods sold, are they increasing or decreasing as a percentage of sales? It means are you getting more efficient or less efficient at producing the goods? SG&A, selling, general, and administrative expenses. Are they growing with sales or a specified percentage of sales? And then depreciation. Well, that depends on your fixed asset balances, your depreciation schedule, and the new fixed assets you're buying, in other words, CapEx, capital expenditures. As we work down our income statement, right, we got our sales, we got our operating expenditures, the next one, and depreciation. The next one will be interest expense. Well, to do that, you're going to need an interest rate and you're going to need a debt balance. You're going to need your taxes, which means you need your average effective tax rate, state, local, federal. Then you're going to move to your balance sheet. You're going to need to know your working capital. That's your investment in short-term assets and liabilities, payables, receivables, inventory. Those often, we say, are just grow with sales. If I'm going to sell 30% more of my product, I'm probably going to have 30% more accounts receivables and payables, and maybe even 30% more inventory. And then you'll need fixed assets, property, plant, and equipment. So that depends on the production capacity and sales growth. If you're growing by 20%, but you have lots of production capacity, maybe you don't need a lot of new property, but you might need more delivery vans, things like that. So you could have an assumption that it grows the same rate of sales. If you're doing that, you're saying, well, there's just a one-for-one relationship between sales and assets. Every time I need to sell 10% more in revenue, I'm going to have 10% more in fixed assets. You might have a fixed asset ratio, meaning that there's always some percentage of sales that are in fixed assets. Or you may also have lumpy forecasted fixed assets because of incremental production capacity. So in other words, you may be able to produce 30% more of your product with your current production facility. So as long as we're only growing by 10%, maybe I can last another 3 years before a major investment. On the other hand, maybe you're already at production capacity and even a 5% growth in sales could lead to a large investment in production capacity as you maybe double the size of your current factory. And then we work down the balance sheet. You got retained earnings. That's always prior year's retained earnings plus additions to retained earnings. Those additions are net income minus the dividends. When you forecast your dividends, you may have a fixed dollar amount, so you know we just pay $2 a share. You may have a dividend growth rate, meaning that we're going to increase our dividend by X% per year, or you just may have a fixed payout ratio that we're always going to pay out, say 5 or 10 or 20% of profits as a dividend. And then as we move down to liabilities and equity, the debt and stock, well, that's a financing decision. After you've done all these other steps, what assets do we need to meet that sales growth? And what is our current level of financing? How much debt and equity do we have? When we forecast the financial statements, it's going to be of several steps. The first step is go ahead and forecast your first take at the income statement and balance sheet with no adjustments to long-term financing. In other words, don't mess around with debt and stock. Just keep it constant. Don't assume you're paying off debt, issuing more debt, buying back stock, or issuing new stock. When you do that, the balance sheet will not balance. And there's nothing forcing it to balance. So what you're going to do is you're going to calculate from this first pass, from just looking at revenue and COGS and SG&A and so on, and those short-term assets and liabilities, you're going to estimate what are your external financing needs. That is going to be the difference between your forecasted balances of assets on the balance sheet minus your forecasted liability and equity, holding stock and debt constant. Your second pass is trying to balance the balance sheet. You're going to look at your external funds needed, the difference between assets and L&A, and you're going to try to plug that difference. You may have to issue more stock or issue more debt to get the balance sheet to balance. In other words, to fund all those new assets purchases. If you have EFN of zero, external funds needed of zero, that means you have too much financing. You're forecasting that sales are going to be less than liability and equity. If that's the case, well, you may be able to retire debt or buy back stock to reduce that L&E balance. When you do the second pass, if you use any debt or play around with any of the debt balances, that's going to affect on interest rates, which is going to have an effect on the income statement, meaning that if the interest expense goes up or down, your net income will go up or down, and which means the additions to retained earnings will go up and down. So what you need to do is you need to do one more pass and maybe a couple more passes to finance that difference in interest. So what we're going to do is we're going to do this first pass of a financial forecast, and we're going to jump to the spreadsheet. I've made a number of assumptions here. We'll take a look at them. So in this spreadsheet here, I have 2019 actual income statement, balance sheet. I got my income statement here and balance sheet down here. And I've made some assumptions. Sales are going to grow by 20%. COGS are going to be 40% of sales. SG&A is going to be 20% of sales. Depreciation expense is going to be a percentage of net fixed assets. Net fixed assets are fixed assets at cost minus accumulated depreciation. Interest paid on debt is going to be 8%. Interest earned on cash balance is going to be 2%. I'll also assume that short-term assets and liability, excluding debt, will grow at the same rate as sales. So the idea of receivables, payables, inventory will just grow at the same rate as sales. And we'll just assume a fixed percentage of net fixed assets. So net fixed assets will wind up being 100% of sales. So for whatever reason, if I'm going to sell $1 million of product, I've determined I need $1 million of fixed assets to do that. And then I'm going to assume no change in bank loans, debt, common stock. I'll keep a common payout ratio of 25%, meaning that 25% of net income is going to be paid out as a dividend. 1 minus that, 75% is my plowback ratio. I'm going to retain 75% of my net income. That's going to go into retained earnings, which is a source of cash to make additional purchases and assets. So we're going to go into the spreadsheet and plug in these forecasted assumptions. We'll start with sales. We assume that sales grow at 1 plus that sales growth rate. COGS are going to be 40% of sales. That's a historical ratio you can see from the prior year's actual. And SG&A is going to be 20% of sales, and that is also the historical average. You can look at 2019. Whoops, that's a multiplication, 20% of sales I then have my EBIT. I can just copy that. My EBIT is going to be sales minus COGS minus SG&A minus depreciation. I can copy that over. And now I have interest expense. Well, interest expense is going to be a calculation. It's going to be the interest rate on debt times the debt balance. And the debt balance has two different components. And that's going to be bank loans and long-term debt. And also I'm going to receive some cash from receive some interest from my cash balances. I'll assume that cash we're going to hold is going to be invested at 2% and earn a little bit of cash. So I'm subtracting off from my interest expense. I'm just going to subtract off the interest income. So this is net interest expense. So to do that, it looks like let's forecast a few balance sheet items to try to get this number to work. The first thing is cash. Well, I'm going to assume that all short-term assets and liabilities, just excluding debt, grow at the same rate as sales. So I'm just going to take my cash balance, extra cash in a cash register is just going to grow at the same rate as sales. I'm going to anchor that sales growth rate. Actually, I can link this down here. And then I'll copy that formula to receivables, payables, other current assets, and I'll copy that to accounts payable. So I'm making the assumption that accounts receivables, payables, other current assets, other current liabilities, and inventory grow at the same rate of sales. Sometimes we call those spontaneous assets. It's not really a decision. It's just when you're getting larger, your scale's larger, you just wind up having more inventory, more payables, more receivables. Okay, so it looks like we have interest expense now because we now have a cash balance, and bank loans and long-term debt are being held constant. So you can see down here, the bank loans are the prior level plus 0, and long-term debt is the prior level plus 0 change. We'll forecast that in the second pass. My EBIT is just going to be, earnings before tax is going to be EBIT minus interest expense. So I'll copy that over. And my net income, well, it looks like I have a calculation of tax. So it's just the prior year's tax rate times the earnings before tax. And then I can copy over my net income line there, which is just my EBT minus my tax. Now I can go down here and see everything is completed. And what I've determined is from the first pass, my forecasted total assets is 1620. So you can think about that as that's the amount of assets I'm going to need to finance this growth. My liabilities and equity is going to be 1467. Notice retained earnings is just prior year's retained earnings plus the additions to retained earnings, which is 75% of current year net income. That's the percent not paid as a dividend. And so it looks like I'm forecasting higher assets than liabilities. The way you can think of the balance sheet is assets are what you own, liabilities and equity is how you financed it. And it looks like I don't have enough money to finance this level of assets, which are then going to drive this level of sales. So we're going to move to the second pass. But before we do that, we're going to take a little bit of break, and then we'll talk about the second pass and external funds needed in the next topic.